I think the most important thing is just this sort of cyclical recovery post-supply, how it shapes up, how the REITs sort of manage around the recovery and manage their messaging around the recovery, right? How they talk about how things are improving, to what degree things are improving, and and how much sort of fundamentals can improve in the coming years as supply goes away.
Hello, welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In today's episode, we're taking our monthly look at a REIT sector. For June, that's residential. And with me to share his insights is Adam Kramer, Vice President of Equity Research at Morgan Stanley. Adam, welcome to the podcast.
Thanks, Sarah. Great to be here.
So, Adam, let's start with the bigger picture. And to what extent would you say macro uncertainty is impacting the outlook for multifamily REITs today?
Yeah, no, it's a great question. And I think in terms of macro uncertainty, there's a few different areas or elements at play here. I think on the one hand, last year, the narrative was around tariffs. This year, obviously, there's the Mideast war situation. We also have sort of the rate increase that we've had the last number of months, as well as some policy factors. And I think each of these probably play a part to some degree in introducing a level of uncertainty for the outlook and for the sector. I think our view has been, though, that fundamentals sort of rule the day. And what matters more is the supply cycle that we've just gone through and what demand looks like today and going forward to sort of get through that last bit of supply and sort of bridge to sort of the next part of the cycle. Look, on the policy side, probably worth mentioning, probably more impactful for the single family rental REITs versus the multifamily REITs. And I think broadly speaking, the Mideast war situation far less impactful than last year's, sort of tariff episode, right? Which I think played a bigger role in introducing headwinds to the sector in terms of consumer confidence, et cetera. I think, again, for us, it's much more about sort of fundamentals, much more about sort of rent growth, occupancy, and how that looks in the recovery from supply.
So let's drill down a little bit more about the supply cycle. Where would you say we are within that cycle, and which geographic markets are likely to inflect first?
I think where we are today is pretty clearly at the end of this cycle. If you look at the under construction pipeline, as of 1Q26, it stood at about 2.7% of inventory. That's the lowest level since 2013. And we are seeing construction activity, the under construction pipeline, declining across all regions. It remains relatively highest in the South at 3.3% of stock. But again, that's way lower than it's been for the last number of years. The Northeast, the West, and the Midwest all have lower percentage of stock under construction. So again, I think the story there is pretty clear. And I think on sort of the even more forward-look basis, when we look at starts data, we see 1Q26 trailing 12-month national new construction starts at about 1.5% of inventory. That's down from 1.8 in 4Q, and it would be the lowest level since 2012. And similar to the under construction pipeline, we're seeing starts decline across all of the different regions in the country. They remain highest, again, on a relative basis in the South, but again, well below what they've been in years past. So when we think about the delivery forecast here, I think the story is pretty clear. We're already seeing lowest levels of delivery since 2021. And our view and the view of the data that we use pretty clearly shows that's going to continue to trend lower and lower over time. I think the bigger question is just going to be, how much demand do we have, and how does demand look over these next few quarters to absorb last quarter and last year's deliveries, some of which has obviously not been leased up yet. So I think for us, the focus has shifted somewhat from supply, from this sort of record supply cycle, to what demand looks like. Just to put some context in terms of markets, I think our forecasts are for next 12 months, the deliveries to be highest in Charlotte, Columbus, Richmond, and Austin. Relatively no surprise there. I think that some of those markets which have been highest on deliveries in recent years continue to see relatively higher deliveries. Of course, less deliveries than what each of those markets have had in recent quarters and years. And then when we look at markets that we think are going to have the lowest deliveries, it's a number of the coastal markets. Again, probably no surprise there. Sacramento, the East Bay, Portland. Bottom line, I think sort of Sunbelt still sees relatively more deliveries, relatively more supply, but again, a lot better than what it's been. And coastal markets continue to be in a relatively better position.
Adam, do you think it's accurate to say that coastal markets are structurally stronger than the Sunbelt?
I think that's a little bit too simplistic in our view. The Sunbelt has had a record supply cycle, and it's not just been the Sunbelt, right? It's been a national supply cycle, although I think very clearly in the data and consistent with the numbers I mentioned earlier, it's been a supply cycle that's been felt most acutely in the Sunbelt. The Sunbelt has benefited historically from better demand. And though some of these drivers have slowed from the COVID inflated highs, right? Population migration was way above pre-COVID during some of the COVID years, 2021, 2022. It has now since slowed back to that pre-COVID trend. But I think importantly, it's back to the pre-COVID trend. I don't think it's worse than that. And so you're still seeing sort of positive immigration, positive job growth, positive other demand drivers. So I do think the Sun Belt has gotten more supply. Likely in the future, it will get relatively more supply than some of the other markets in the country. But our view is that it'll likely have better fundamentals and better demand drivers as well. And so it's just a question of how do those two match up. So coastal markets, I think there are points in the cycle when they do screen better. Right now being a good example where Sunbelt is still dealing with oversupply and still dealing with elevated levels of concessions that the coastal markets don't have to the same degree. But I think to say that it's a structural issue, I think maybe overlooking the sort of better demand that the Sunbelt benefits from typically as well.
And Adam, can you talk a little bit about the type of deviation that you're seeing within submarkets within broader metro areas?
Yeah, it's a great question because I think, over the last few years, given the magnitude of supply, nuance, right? Some market differentiation sort of mattered less, right? It was just oversupply everywhere, almost as simple as that. But we do think the conversation is moving back to one of market and some market differentiation where nuance is going to be more important. And this was a key theme coming out of a non-deal roadshow we had with MAA last week. They talked about how sort of Austin holistically had negative double-digit new lease growth a year ago. Again, probably not a surprise to folks to hear that, given the level of supply, given the level of concessions. This is on a net effective basis. But you fast forward a year and you're actually seeing the south part of Austin, some markets in the south of the market improve, still have negative new lease growth, but negative, probably low single digits, maybe negative 5% at this point, versus the north that has had some level of improvement, but much less so versus the south. And so a market a year ago that very clearly was just oversupplied and in a tough spot has now had a pretty good degree of improvement in parts of the market while others still lag. And I don't think it's just a sort of Austin example either, right? I think Austin is a great example of it, but I think this is something we're seeing across other markets in the country as well. I think Atlanta, Dallas, two other sort of classic oversupply markets are also seeing some level of some market differentiation as well.
How are these various trends all coming together to impact NOI growth at this point?
So look, market rent growth has been less than 1% for over a year. This is using CoStar data. That's on a gross basis. If you look at it on a net effective basis, including the impacts of concessions, rent growth has been negative for a number of quarters now. So it's pretty clear to us that this has been a tough environment. I think you look at what the public REITs have reported, and it's a pretty consistent story with what sort of the high level top down data shows as well. Rent growth has been relatively better in the Midwest and Northeast, call it positive 2% or so in those regions and markets in those regions. It's been slightly negative in the West, although San Francisco, Seattle are seeing probably the greatest improvements, the sort of second derivative improvements, and seeing worse rent growth in the South. Again, no surprise there given supply. We think these drivers and data points are probably pretty widely understood by the market at this point. And, national occupancy is in the mid 91% today, which is below the long run average. But again, there's signs that I think it is improving to some degree. MAA shows a chart of their markets, including the effect of lease-up assets, and you're sort of back to the pre-supply high points from 2022. So I think there's encouraging signs in occupancy as well. And then bridging that to NOI growth, look, same-store revenue growth has benefited from better renewals, right? Renewals have hung in remarkably well across the industry, right? In the sort of relatively better coastal markets, in the more oversupplied Sunbelt markets. Renewal growth has been somewhat of an equalizer here in terms of same-store revenue growth, where renewals have been positive in the low to mid-single digits, and that's both in the relatively less supplied coastal markets and the more oversupplied Sunbelt markets. And same-store expense growth has been more modest in recent years as insurance issues and tax issues have normalized. But again, given the state of new lease growth, it's led to pretty tepid NOI growth overall. Again, more so a function of just what's happening on the new lease and pricing power side.
And Adam, if interest rates do stay elevated, how would you say REIT balance sheets are positioned to cope with that situation?
Yeah, I think REIT balance sheets are in great shape to cope with that. Obviously, it's not an outcome that these REITs would want, but if you look at net debt to EBITDA across the sector, You have MAA that's at the low end in the mid fours. Others are in a similar spot to them. UDR and ESS are at the sort of relatively higher end in the mid fives, but they're still in great shape within their own target ranges, within the broader REIT space, underlevered compared to the broader REIT space. So I think the space broadly is in good shape. If you look at where weighted average interest rates are on an in-place debt for the group, it's pretty similar. UDR is slightly lower, CPT is slightly higher. So bottom line is everyone is in a relatively similar spot. Earnings growth will probably have a modest headwind from refinancing for the coming years, but again, I think it's a minor one. And given steady maturity schedules and low quantum of debt, yeah, again, these REITs should be in pretty good shape.
And finally, Adam, any particular themes or issues that you think REIT management teams will be prioritizing in the year ahead?
Yeah, look, I think the most important thing is just this sort of cyclical recovery post-supply, how it shapes up, how the REITs sort of manage around the recovery and manage their messaging around the recovery, right? How they talk about how things are improving, to what degree things are improving, and how much sort of fundamentals can improve in the coming years as supply goes away. Look, I think internally, REITs are focused on capital allocation, right? I think a theme, a trend that we've seen over the last 6 months, probably even closer to a year at this point, is buybacks. So you've seen REITs dispose of assets at really attractive cap rates to go finance buybacks of their own stock at wider implied cap rates versus where they're selling assets at. And so I do think that as long as these REITs continue to trade at attractive valuations, you'll probably see more so an emphasis on buybacks. And then some REITs are also prioritizing development. And so I think that a major theme for some of these REITs, at least, is going to be that sort of balance of buybacks versus development.
Adam, thank you so much for your time today.
Great. Thanks, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.